We're answering a viewer question about the housing market. With interest rates so high these days, at times reaching more than 6%, many of you are trying to find ways to keep costs down. Tonight, we explain what it means to assume a mortgage. Viewer Laura writes, a friend of ours just bought their first home by assuming a 3% mortgage rate from the sellers. Can you explain how that works? Seems like a great way to bypass the higher interest rates right now. I took this question to real estate broker Kevin Oto, the owner of Greenhaven Capital. Can you explain how that works?
So if you're assuming someone's mortgage, it means you're buying a house and the buyer is going to take over the seller's existing mortgage and keeping that low rates.
Assuming a mortgage allows a buyer to take over a seller's existing home loan, including the remaining balance, interest rate, and repayment term.
A seller that may have bought their house, in 2021 or 22 when rates were really low, locked into 3%, you could essentially try to assume that person's loan. So instead of getting a loan at today's higher rates, they're stepping into an older loan at a 3% rate or a lower rate, which could make that loan very attractive and help with affordability.
It's primarily used for FHA, VA, and USDA loans, which are government-sponsored loans, to secure lower than market interest rates, requiring the buyer to pay the seller for the home equity difference. Assuming a mortgage may get you into a lower rate, but Oto says this comes with big caveats you need to be aware of.
It's possible, but it's not as easy as it sounds. So the loan, first of all, has to be assumable. And typically it's only FHA or VA or USDA loans that are assumable. So conventional loans are typically not assumable.
Oto also says the buyer still has to qualify with that seller's existing lender, just like a normal loan. But one of the biggest challenges is timing.
Assumptions can take a couple of months to complete. So in a competitive market where a seller could be getting multiple offers, most sellers aren't going to wait that long if they have faster options. So it could be a really good opportunity, but it's not something a buyer can necessarily rely on.
So remember when I said the buyer would also have to pay the seller the home equity difference, meaning paying the difference between the current loan balance and the purchase price. Oto says most lenders are not going to give a second mortgage on an assumed mortgage to bridge that gap. So you, as the buyer, will have to find a way to come up with the money. Stream all of our Dollars and Cents coverage on the free ABC 10 app. Email me your money questions at lpainter@abc10.com.